All right, Scott, we talk about a rebound that I guess is deserved given what the president took off the table. How much stock can you put in that in terms of seeing some persistence to this rally, if not over the next 90 days, even beyond?
Well, I think you can put some stock in it. I think, we've been looking for an off-ramp to what was announced with Liberation Day. And so remember, the negative aspect of the 20% plus tariffs that kind of came out of Liberation Day was this view that there was no apparent path to negotiate that, and so that it defined your maximum negative aspect in terms of what stocks were discounting on this uncertainty element. Now, what's happened, you've begun to alleviate that. And you have to remember that various components of the Mag 7 are down as much as, well, in Tesla's case, over 50% from 52-week highs, others down, 20 to 35%. So the opportunity for these stocks to snap back is something that has been in our playbook. We went overweight tech going into Q2 just a couple of weeks ago, led by an upgrade to software alongside semis. We had been underweight hardware, which was the nagging China concern on Apple. That moves to the sidelines, but not completely for now. But what I would say here is that the degree of the negativity, the valuation disconnect, the underlying AI-related spending tailwinds that are still at work all make us of the view that this mega cap growth, tech-led bias, we think probably persists in the short term.
I am curious about the other end of the spectrum, Scott. We're seeing a pretty massive rally today in some of the more economically sensitive sectors. Dow Transports as a group up about 10%. The Russell up about 9% as well. Mid caps also up about 8 or 9%, Scott. Do you think there's hope there for some of those companies that really weren't directly exposed to the trade and tariff risk, but maybe they were exposed to the potential domestic economic risk?
Yeah, so look, the way we would talk about the playbook, we would kind of lean in with this growth bias. It's been our view because we haven't, to your earlier discussions, haven't completely eliminated the economic concern that's been going on even before we got to last week's Liberation Day. That's kept the small cap part of the market at bay, right? And so I think we need to get a little bit further, probably the other side of the Q1 reporting period, get a little bit more confidence that we're seeing a bottoming in fundamentals that we had not found yet anyway, before we kind of come back to that part more aggressively. But clearly, anytime you breathe a sigh of relief on underlying economic activity, small cap's going to feel that leverage. We still feel like, from our perspective, is that playing this growth narrative, I think, where you still have very, very visible free cash flow generation component at work here, combined with secular tailwinds, is probably still the best trade in the short term anyway.
So, Scott, to be clear, it doesn't seem like you've changed your call at all in the last 2 hours.
Correct. I mean, the playbook that we laid out going in, we were obviously pretty nervous about it as we went through Liberation Day, but we kind of stuck with this view that growth is defensive is a theme that you want to be on. We haven't completely eliminated that economic valley that might potentially be out there. It's the depth of it's probably a little bit less than it was, but our playbook is still pretty much intact.
If we keep high tariffs on China, though, and vice versa, does that disrupt things? I mean, we were talking about Apple, and that was really the poster child for trade issues between the U.S. and China, and that ripping higher today, even though those tariffs are still on.
Yeah, I think, Alex, I mean, it certainly does. But I think what the market's taken its cue from here is that, OK, great, we've gone back with another round of tariffs on China. But, with the messaging you heard from Secretary Besson is that we got the trade conversation where we wanted, and that's where we get countries to negotiate. And so I think the markets, in looking at the Apple action today, is presuming that, OK, great, it's going to take a little bit longer with China, but some presumption that ultimately we'll get there.
I am curious, though, Scott, too, about the earnings season that is basically kicked off today. We got Delta Airlines this morning, and as expected, the CEO there pulling guidance. We're heading into an earnings season where these companies and executives are going to be peppered with questions about how they see the rest of the year. Even given what's transpired today, Scott, do you think they will be able to articulate some degree of guidance, even if it is a broad range?
Romain, it's a good question. I think we've been prepared that there's going to be a combination of pulling guidance, banding guidance, or being more firm on what you know and don't know around the outlook that would all come out in Q1, which we thought would lead to generally speaking, a negative revision bias. I've not been a fan of eliminating guidance. I think there's so much uncertainty in the market right now that investors want to at least to be able to identify sort of what a worst case might be. We did the same thing in our own work. We put out a thought piece over the weekend that was a hypothetical that said 4,700 on the S&P begins to price in what we think the full extent of tariffs would be. And what that really is intended to do is to provide a framework from which you can work back as the news flow unfolds. So I still think net we're going to see a negative revision to numbers as we go through the Q1 reporting period. But I think we're probably going to see a little bit more nuanced perspective out of C-suites given today's action.